Hello everyone, welcome back to another episode of Boss Economics World. Today's show will be like another round of peeling an onion. It's dry, you might shed a tear, and by the time you get to the center, you'll be asking yourself, what's left? Just like the current state of our economy, which is unraveling layer by layer, revealing the complexity of mismanagement, confusion, and outright incompetence. Today we'll pick apart the recent speech by Jeffrey Schmid, president of the Kansas City Fed, and try to dissect the underlying economic imbalances that are brewing behind the slow reduction of interest rates. Spoiler alert, it's kind of a mess. According to Schmid, the Federal Reserve plans to take a cautiously slow approach when it comes to cutting interest rates as they attempt to sustain economic growth, stabilize inflation, and tame the labor market. We've just seen the first rate cut since the pandemic, a rather sharp 50 bps drop, leaving us wondering if the market's been nervously teetering on the brink to the point where just one quick move could send it over the edge. Let's break down this situation. Schmid indicates a preference for modest adjustments, cautioning against overreaction, or in layman's terms, the Fed is walking on eggshells. This speaks to the fear brewing within: push too hard, and the market could collapse. Go too slowly, and the economy continues to choke under financial pressure. You see, it's no longer about saving the economy but rather managing calamity at an artificially prolonged pace. But here's the most revealing part: Schmid and other policymakers highlight increased market uncertainty as the reason to slow the pace of rate reductions. So, it's not necessarily that policymakers are confident the economy is getting healthier, they are more unsure about the short-term future. Look, if these economists aren't clear about the destination, it begs the question, why did we drift into this precarious position in the first place? We'll talk about that in just a bit. Schmid spoke directly about the labor market shrinkage. Companies are no longer aggressively hoarding workers, and the post-pandemic employment frenzy is dying down. Does that mean good news? Perhaps, for a portion of the economy, but a deeper read shows businesses and employers pulling back on hiring, signaling more uncertainty. You see, what Schmid and the Fed deem a normalization, others might interpret as lack of confidence in sustained demand. In other words, people aren't hiring at the same pace because businesses smell trouble ahead. Of course, that conversation about normalization leads to the less optimistic truth: this labor market cooling could very well morph into an employment slowdown. Stick with me on this. A slower labor market almost always impacts consumer spending, which, given America's consumption-based economic structure, feeds directly into broader recessions. Now, why are businesses starting to tread carefully? Let's zoom out for a comprehensive view. One crucial statement to focus on was Schmid's acknowledgement of interest rates remaining higher than pre-pandemic levels. We are looking at deeply ingrained structural factors like ongoing government debt issues and population aging that might keep rates high. Just when an entire population thought it could come up for air, guess what? We're diving deeper. What people forget here is that prior to the pandemic, interest rates were historically low for a reason. They were kept low to stimulate an economy already crawling through sluggish recovery. And now, when the general populace is getting squeezed with inflation, debts are ballooning, and wages aren't increasing fast enough to match inflation, high interest rates simply add pressure on household borrowing, especially mortgages. It's as if the very system Americans depend on to finance the middle-class dream has become the very barrier keeping low- and middle-income families from easing out of their long-standing financial discomfort. Higher interest rates negatively affect consumer confidence and business expansion plans. So, if rates settle well above pre-pandemic levels as Schmid suggests, investments in businesses and job creation will dry up at a much faster rate than before. The housing market specifically becomes a victim. The affordability crisis, already excruciating for many, turns into an endless nightmare where owning a home might permanently drift out of reach for millions of Americans. The yield curve, folks, is a key metric in financial markets. Schmid touches on it lightly, but let me illustrate it with bolder strokes. The yield curve, basically the gap between long-term and short-term interest rates, has been signaling recession threat after recession threat. When the curve inverts, it usually foretells economic doom. Schmid hints that the Fed's massive balance sheet, specifically loaded with long-term mortgage-backed securities, is exacerbating the problem. Why? Because when the central bank holds a lot of long-term debt, it artificially depresses long-term yields compared to short-term yields, distorting the natural flow of credit in the economy. Translation: Fed actions have exacerbated this economic distortion, causing inefficiency in how money is allocated across the market. Financial markets need a proper balance. Short-term rates need to be lower than long-term rates to encourage investment in smooth financial liquidity. But rather than letting the natural course of borrowing and lending heal the market, the Fed's policies have made this worse. What's ironic is how Schmid underscores the importance of maintaining a positive slope in the yield curve for the health of traditional banking. What he doesn't fully acknowledge, however, is how Fed missteps in the last 15 years put us on this jagged roller coaster that now appears to have no safe exit. The mention of global productivity growth, or lack thereof, might sound like distant policy chatter, but let's get real about how it trickles down to American households. As inflation continues to accelerate globally, productivity projections aren't keeping up. Eventually, that bottleneck makes its way into every American family's dinner conversation: are my wages keeping up with prices? The answer is alarmingly clear: no. Looking at wage stagnation trends for the past few years, real wages have barely moved compared to the surges in living costs, especially when you factor in the cost of housing, healthcare, and education. Now, combine this with ongoing international trade disputes, and a slowing global economy doesn't just mean we'll see less cheap goods at Walmart, it means American producers, rooted in an already shaky economy, will contend with lower demand abroad as well. So, where does all of this leave us, folks? Schmid and other Fed officials, including Lori Logan and Neil Kashkari, have alluded to the necessity of taking things slow. A responsible notion, but one that hides an undeniable truth: whether policymakers react slowly or quickly, the dice are already rolling. The real economy, the one made up of workers and small businesses, isn't reacting to these controlled policy decisions with grace and solvency. Instead, most Americans are feeling the harsh blows of mounting inflation with no end in sight. Even if the Fed chooses gradual rate cuts, the structural weaknesses already present, rising household debt, unsustainable living costs, and systemic problems in areas like housing and healthcare, are likely to persist or worsen. Here's the million-dollar question: can we trust the Fed to stabilize a ship that's already lopsided? Jeffrey Schmid and the other Fed officials clearly recognize the fine line between too little and too much policy intervention in a time where market volatility is through the roof. Yet, the deeper issues have been growing beneath the surface for much longer, clearly evidenced by unresolved systemic risks predating the pandemic. While the Fed attempts to engineer a slow landing, the reality for the average worker or homeowner is shaping up to be quite the opposite. Every economic indicator, from inflation whispers to consumer spending tremors, suggests that we are living on borrowed time. The steps the Fed takes are habitually reactive, not proactive, and if they continue to tiptoe around financial markets, we could end up with the worst of both worlds: an economy stagnating under tight monetary conditions with no conceivable way out. So, will this slow and steady technique work out? Or are we just delaying an inevitable economic blowout under the guise of cautious optimism? Only time will tell, but one thing's for sure: just like peeling an onion, we've still got many layers of tiers to go through before we strike the core of this mess. Thank you all for tuning in today. Don't forget to subscribe to the channel if you want more straight-talking, no-nonsense breakdowns of our latest economic challenges. Stay critical, stay informed, and remember, what you don't know about your money can hurt you.